guys. Thank you very much for joining us today. So I'll start it off. Let me introduce the moderator of the event and your lender, Amazon.com, best-selling author and international speaker. Shashank is widely regarded as America's premier mortgage expert. He has been featured on Yahoo News, ABC, CBS, Fox, NBC, USA Today, and several other media outlets for his expertise. He has been named top 40 under 40 most influential mortgage professionals in the country, top 25 most connected mortgage professionals in the country, as well as top 50 loan officers in the country. Let me welcome Shashank Shekhar, founder and CEO of Arcus Lending.
Thank you, Vince. Okay, thank you so much for taking time out and coming here. I'll just start with some of the logistics here, and then we'll get started with the event. It is a panel discussion, so I'll introduce our panels here in just a little bit. And the way we'll structure it is that in the beginning, the three of us will be speaking, mostly. Unless you have a very, very pressing question, keep that for the question and answer session, which we'll do towards the second half of the presentation. And you'll have enough time to ask your questions after we're done. Our esteemed panel here. To my left is Amar. Amar was in the tech industry for over 20 years before he decided to cross over to the dark side. And move this up. And joined the real estate industry. The company, he works for Keller Williams, which is the largest real estate company in the country. And in a very short period of time, he has moved to become the number 4 real estate agent in the entire country for Keller Williams. To his left, we have Prasanna Kumar. He's an enrolled agent admitted to practice before IRS, and he also holds a master's degree in business administration. Prasanna has been part of my tax filer since 2009. And he currently oversees their Bay Area operations. He has extensive experience in the area of personal and business tax planning, helping individuals and owners of small businesses minimize the total impact of business and personal taxes. Prasanna will of course be handling all our tax-related questions, and Amar will be talking about the real estate market. So I have broken this down, the entire presentation, into about 4 major factors. We'll start with planning, because a lot of you here may be at different stages of home buying. Some of you would probably have already crossed the part 1 and probably would have moved to part 2. But the way we'll do it is that, assuming that all of you are still in the planning stage, you're still thinking of buying your first home, and what is it the first thing that you do? So we'll move from planning to home search. Once you find the home, then what happens after that, and how do you move to closing? So there are really 4 big parameters here under which we'll be talking about. So I'll start by talking about planning and talk about what is it that you need to take care of even before you can get into the market and start thinking of buying a home. And these are the things that's very important for you to take care of. Otherwise, I've seen a lot of people who are underprepared when they're thinking of buying a home, and sometimes too late by the time they get in the market, and they have not taken care of the things that they should have. So the 4 things that you really need to take care of when you're thinking of buying a home is credit, income, employment, and assets. And you have to be prepared with all those 4 things before you get into the market. And I'll talk about all 4 things individually, and we'll tell you how you can work on those things and be ready. So let me first talk. Before we get into the 4 important parameters here, and I'll then involve our panelists here, I briefly want to get some overview on the real estate market so that you get a sense of, we are sitting in end of October, November here. I'll put that question to Amar here, and would like to know your opinion on where do you think, how did the market do this year, and if you can comment both probably on the South Bay and the East Bay market, Amar. And then where do you think they're heading in next year? Because a lot of people sitting here, that is probably one of the biggest questions in their head if they're thinking of buying the home, is where the real estate market is and where do you think they're heading, so that they can take a decision on is this a good time to buy.
My name is Amar, as Shashank mentioned. Please feel free to ask any questions you have. This is interactive session. Definitely, I mean, I'm sure you all pay the rent. You can see that how much you are paying for the rent and versus the cost of the having a loan. Definitely, is the Bay Area. You have seen that one on the places. It's gone up. So maybe it's an average 78% in the city. Past few years, and it's continuing to go next year too. I can send you that's complete data. It's compiled by National Association of Realtors. On slides, the complete data for it. So it's good time to buy. Absolutely. If you're not the need of schools right now, in fact it's perfect time to buy without competing with a lot of multiple offers. Especially October, November, December, January, February. This is the time you don't see many people, school parents especially, competing for that. After February, March, more inventory come to market and more people tend to buy. Definitely, at least we can expect 5 to 6% minimum growth in real estate next year, both in South Bay and East.
So that's interesting that Amar mentioned that time for first-time home buyers to get in. How many of you listen to my radio show? Okay. I'm not sure if you heard the segment where I talked about what's the best months to buy for a first-time home buyer. Did anyone catch that? What was the best month? November? Anybody else?
Around the year.
Around the year? Bay Area, maybe, yeah, that may not be a wrong answer. So, it's proven through stats and research over last 10 years they actually looked at the exact month where the home buyers are able to buy at a slightly lower price than most other months. Unfortunately, today is the last day of that month, so it's you still have a few hours to try and get into offer. Amar, can you still help them? That's what Amar was mentioning too. I had a lot of first-time home buyers come to me for consultation at the beginning of the year, and I was telling them exactly what Amar is saying right now, which is if you can wait for the fall and winter season. It's real estate market is a little cyclical. It does tend to go down just a tad bit, not a lot in the Bay Area, of course, but just a tad bit during fall and winter. And then after Super Bowls, once you get into the home buying season of February, March, April, May, June, pretty much all the way till about August, September, you run into a very, very crazy market. And Amar just said he thinks next year we should still see about 5 to 7% appreciation on the back of over 15 to 17% appreciation that we saw this year. So depending on where are you on the stage of your home buying decision, if you can sneak in, say in next 2, 3, 4 months, you will probably be able to buy something for just a tad bit lower than what it will be once you get into the home buying season, which starts a little late in February. So that's just a feel of where the real estate market, those two areas happen to be the hot zone for first-time home buyers. That brings me to some of the 4 other important topics that I talked about, which is credit. 2 years back, and they said the number one reason why first-time home buyers are not able to buy homes faster is because of the lack of down payment. And that's a national phenomenon, and that's something I see consultants. Their biggest challenge usually is not credit, the down payment. And that's where I want to get Prasanna's opinion on a couple of things here, which is so of course, one way of getting down payment is just from your own savings. If you have money in your checking savings account, of course you can use that. You may have companies' stocks, you may have your own stocks, of course you can sell that and use that towards down payment. But if you're trying to use sources which are not that conventional or do not come to your mind right off the bat, and that's something that we talk about consulting to home buyers, which is things like getting loan from 401k, things like getting gifts from your parents or getting gifts from your relatives. And one of the questions that I get asked all the time, which is, what are the tax consequences of doing this? So if I get gift from my parents in India, or if I get gifts from my siblings here in the US, or if I borrow against 401k, how much tax do I have to pay for something like this? So Prasanna, if I can get your opinion on 2 different things. Question 1 is the 401k as a loan versus if you are just withdrawing from 401k. What are the different tax implications of this? And then I'll come to the gift part after that.
Thank you, Shashank. This is Prasanna from Paris agent. basically you can go for withdrawing, borrowing loan for okay up to 24 okay, if you're not if you're using. Yeah. You have an option to borrow up to 50% of the account value or maximum of 50,000 or if you're going for a home loan procedure kind of thing. So there is no interest, that's going to be your own interest you're paying to your account. And if you're planning to withdraw money from the 401k, you will be subject to our taxes. The taxes are going to be based on your tax rate and this is on the withdrawal penalties. However, if you have IRA, traditional or Roth IRA kind of borrow, you can withdraw up to 10,000 from your IRA account. If you're using that 10,000 for home improvement or to acquire a home, there won't be any early withdrawal penalty. So basically, there are two things involved. One is the penalty and the other one is taxes. So penalty is applicable if you withdraw money from 401k or the IRA account. So in your case, if you withdraw up to 10,000 for buying a house, there won't be any early withdrawal penalty.
Has a 401k account, they can borrow up to any tax implications. And the interest that they pay on a 401k loan is paid to themselves. So really, they're not really paying to a bank or somebody else. Okay, that makes, of course, getting a loan against 401k one of the best options to use for down payment. Because one, you're not paying, it has no tax implications at all. And two, the interest that you're paying is actually the interest that you're paying yourself to your own funds. That's great. But withdrawing from 401k, of course, is not a great idea, and it should be avoided if we can. Okay, let's talk about the second down payment that we talked about, which is gifts, which again is a very common form. I'll come to you. Which is a very common form of gift. Talk about getting gifts from here, someone. Say my siblings live here, or even my parents live here in the U.S. versus getting the gift from India, and what are the tax implications for people living there, or what are the tax implications for me as a receiver of the gift?
Okay, gift from US person, so the donee has no tax implications. You don't need to file any form if you are getting a gift from a US person, but the donor has the tax implications. If donor is giving more than 14,000 for a person, they need to file a tax return, gift tax return. However, there is no taxes payable on it because there is a exemption credit on the gift tax filing. And if a person is married and there are no tax implications. If you are going to get a gift from a foreign person, you can get up to 100,000. 100,000, there is a form required to reporting required to IRS. However, there is no tax on it.
That's another good news. So again, 100,000 from out of country person, and even within the country, even though they have to file a form, they really don't have to pay any taxes. So 14,000 or 28,000 if they're married. 20. You guys had a question back there. What's your question? Sure, Prasanna, did you hear that?
401k will not allow you to withdraw money. So if you are withdrawing from 401k, there is no early withdrawal penalty exemption. Only IRA, traditional and Roth will have an option to withdraw 10,000.
No, but can they get a loan of 50,000 from
you can get a
401k
loan
plus?
of 50,000 from 401k.
So you can do that. Can you, let's wait for them.
Can you talk about
Right. Yes. So let's assume you have two people who can give you from a foreign country. If you are getting from one person 60k and the other person 60k, totally 120k per annum. If you are getting more than 100k, then you need to file more than 100. That's right. No, it remains like 100. Even if it is divided, since we are filing, if tax return is filed as a joint, so if you get more than 100,000, even if you split that, then you need to report that transaction.
So those are some of the ways you can try to get your down payment if you don't have your checking savings account. And try to keep your questions towards the end because you will have enough time to ask that unless it's very pressing and you need to absolutely ask it right now. I would rather follow the pattern and try to get everyone all the information they need and then get you out by the time we committed you to be out of it. So we talked about assets, we talked about the real estate market. Now let's briefly talk about what are the requirements for credit, income, and employment. Because a lot of us come to the country and we are not fully prepared in terms of what kind of credit history we have, what kind of income or employment history we have, and then we run into challenges when we try to get a loan. Rule of thumb says that you have to have 2 years of credit, income, and employment history in the US to qualify for a loan. There are exceptions. Talk to me separately and we'll talk about some of the exceptions that are available. But broadly speaking, you need to have 2 years history for everything. You need to have 2 years of credit history. By credit history, it means when was the first time you took a debt when you came to the US. So when was the first credit card you got, when was the first you reported to your credit report, and then you have to wait 2 years after that, and then that's called 2 years credit history. Same with income. You need to have 2 years of income history. There are situations where we can use Indian employment history and Indian income history and kind of work through it. And we are able to do that in some cases. But mostly, as I said, rule of thumb, that's immigration status. Or EAD, and they think they absolutely need to wait to get a green card or to be a citizen to buy a home here. One, of course, there is no... almost 1/3 of our client at Arcus Lending are non-permanent residents. So for us, other than a couple of loan programs where they only require permanent residents and citizens, there's really no differentiation to whether you're an H-1B or EAD or you have a green card or you're a citizen. You qualify for exactly the same terms. Because again, some people think they get a higher interest rate because they are an H-1B or for that or an EAD, and that's not true. You qualify for pretty much every single loan program that's available here, and you do not have to wait to become a permanent resident or a citizen to get a loan. So be very clear about that. Now, we talked about the credit history for a couple of years, which is what is important. Now, also understand that we'll briefly talk about credit here. Is that there are 5 things that impact your credit, and that's something which is most people don't understand how your credit scores work. One is that there is difference between the consumer credit score that you see and the mortgage credit score that we see. A lot of people will come to me and they say, oh, I saw my score on Credit Karma and I saw 760 a score. So that should be our score. And I pull the credit and I see 690 a score. It's because the score that you get from Credit Karma or Discover or Citi or Bank of America or whoever gives you this score, that score is called consumer credit score. That's not a mortgage credit score. So a lot of people get confused with this. Oh, there must be something wrong because I just checked it 3 seconds back and my credit score was something else than what you're telling me the credit score is. It's because we use a different algorithm when deciding what your score is. It's required by the 3 credit bureaus that we use the most stringent to come up with the credit scores. And that's why consumer credit scores are typically higher than mortgage credit scores. So while it's a good idea to monitor your credit scores via sites like whichever site that you go to, it's not always, don't always be sure that that's the score that your mortgage company will see when they pull the scores. In fact, be ready that those scores will probably be slightly lower than what you see online. So number one, it's very, very important because a lot of people get into this assumption that what they see is what they get. They won't. And in fact, even if you go and get an auto loan, the score that you see is not again what the score will see. Auto loan mostly uses consumer credit score, which again, as a mortgage company, we don't. And when I say we don't, it means the entire industry doesn't. It's not as if Bank of America will use something else or Wells Fargo will use something else. Now let's talk about the factors that impact your credit. First of all, your income and how much money you have in the bank does not impact your credit score. So it really doesn't matter how much money you have sitting in the bank or how long you have been in the country or how many bank accounts you have. It has no bearing on your credit score. So what impacts credit score? Go. Say.
Auto loans, credit cards, how often you pay your, are you on time on payments?
Okay, so payment history. Are you on time on your payments? Okay. number of accounts that you have,
No late payment.
number of inquiries that you have.
No late payment and no more late payment.
No late payment and not using 50% of your credit limit.
More than 50%.
More than, so you should stay under 50% of your credit limit. What else? Okay, so you're mostly right. The payment history is the number one factor. It contributes to 35% of your score. So if you are on time and you have been on time on all your payments, say for last several years, you definitely have a chance of having a much higher credit score. The flip side to that is that even if you miss a $20 Verizon payment and it goes to collections, you could be hit up to 60 to 80 points on your score. And I have seen that, I can't even comment how many times I've seen that, where people are like, I should have an excellent credit, I don't think my score will be anything less than 760, 780. We pull the credit, we see 680, 684, whatever. The reason is they moved out of an apartment or they moved out of another house that they lived in. There was a last payment that came from a cable company or PG&E or something, and it was, usually it's like $20 payment or a $40, so it's not something people will intentionally miss, but they never followed up. They didn't even know that it existed, and now they send it to collections, and we pull the credit and we see a 70 points drop, 80 points drop, and usually there's no recourse to that. You missed it, you missed it. You went to collections, you're dead. That's what it is. So, and sometimes it may be too late for you to fix it because maybe you're already in contract, you already need to close a mortgage in 3 weeks, and you can't really go back and change all of that. So if you are getting closer to buying a home, make sure you are staggering your payment across all credit cards so that every single credit card is under 30% of the limit, and none of them, of course, ever exceed that limit. If you're not in the process of buying a home, it doesn't matter, you can use whatever card that you want to. So that's another mistake that people do, which is overuse of their one credit card and just letting other credit cards stay in the wallet the way it is. There is also, you get a small hit for the credit history. And that's something which pretty much all of us cannot control because we came to the country when you came to the country, and if you have 3 years credit history, you can stretch that to 5 years. However, one of the things that I do suggest is that try to get a debt as soon as you can. Because most of us come from India and we think, and we have been taught that not to take debt, and we try to avoid it for as much as we can, and they proudly tell me that, oh, I bought my car all cash. I said, that doesn't sound good to me. So it's, while it may be a good thing not to take too much debt, it's probably a chicken and egg story here in the US. If you don't take debt, you don't get your credit score, which means you can't take more debts if you wanted to in the future. So make sure you do that. You take your first debt the moment you can and try to keep it for as long as you can. Again, a lot of people will very proudly tell me how quickly they paid off their car loan because they had the money in the bank and they didn't want to have that debt, which is not a good news for me because that impacts your credit score. Keep your auto loan for as long as you can because the longer it will stay on your credit report, the better points you will get out of it. And finally, the one other factor again which I see impacting the scores a lot of time, which is having too many credit cards. Usually your revolving card shouldn't exceed 3, tops 5, but usually 3. Especially if you take lower limit store cards like Gap and Macy's and JCPenney's of the world. If you absolutely shop at one place, there. But don't just go to every single store because they give you 10% discount on a $7 skirt that you bought so that you can just save 70 cents off it. Oh, let me get that card. It's free anyway. What's the big deal? Don't do that. Take 1 or 2 of the stores that you most frequently visit and that gives you discounts. I totally get it. But don't just keep accumulating a store credit cards. It just doesn't help you. Try to keep your credit cards to 3 tops. If you really have to go to 5, but 3 is what the ideal limit for a revolving card is. So somebody actually mentioned that what kind of loans you have impacts your credit. So you should have a good balance of, say, an installment loan, a couple of credit cards, and of course in the future have a mortgage on your credit report because that's a perfect balance. If you have too many credit cards and no installment loans, credit bureaus don't like that. And so you should try to stay under 3 credit cards in most cases and use them actively so that they are reported to the bureaus and you get positive points on that. I'll quickly just ask any question on credit report before I move on to the next topic. You cannot. The only way to find mortgage credit score is to go to a mortgage lender and get your score pulled. There is no other place on earth you can get this. Okay, so 10% of your credit score does get impacted by inquiries on your credit report. So if you are in the market and get your credit pulled all the time from different store cards or auto loans or whatever, it will have an impact on your card. How much does it impact is based on several factors. The more thin your credit is, the more impact it will have. What it means is, see if you recently came to the country and you only have one account on your card, on your report, and you have 10 inquiries on it, then that impacts your credit more than somebody who has been, say, 10 years in the country and has 4 or 5 already solid accounts on their credit report, and then they have much less impact. The other thing is that if you get your credit pulled for the same reason within 30 days, it only impacts your credit the first time. A lot of people have this problem is that, oh, I just got pre-approved from Wells Fargo, I really love you guys, I would want to get pre-approved from you, but I don't want you to pull my credit again. Really, it has no impact. If you, whatever the negative impact it has to have is already done by the Wells Fargo guys. If we pull it again within 30 days, there is no further negative impact on it. But if you come to me after 30 days and we pull the credit scores again, then it might impact your score by 2 to 5 points or 7 points, again, depending on a few factors. So wherever possible, try to keep your inquiries to the minimum, but don't always think that every single inquiry impacts it negatively. It doesn't always happen that way.
Say a little louder.
Okay, so this question, if you lose some points on your credit report, how do you build up that credit, those points? There are no quick fixes to it. It's not as there's no way to do that. The only way to do that is there's something wrong with your credit report already. For example, say if you're overutilized on your credit card. If you are overutilized on your credit card, then I can advise you that, okay, why don't you go ahead and pay down that credit card, and when you do that, when the rescoring happens, you will see a better credit score. But yeah, there is really no other way of doing it. If your credit report is impacted once, it's impacted unless there is something else you can do to fix it. One final question on credit. Really good question. So say if you have had a credit card for 5 years, whatever, and you have rarely used it or never used it, does that impact your credit report? It does not give you a negative point. You lose some of the positive points it gathered, and I'll tell you how. Say you came to the country and it was the first card you got. Usually we get a secured card to begin with, which is a $500 limit. And it's the best thing we got in America when we land, and we fall in love with it, but suddenly when we get offers from American Expresses and Chases of the world, $500 card, nobody uses that anymore. The moment a card moves from an active to an inactive state, which happens when you don't use a credit card typically for 4 to 6 months, all the positive points that credit card gathered for you, you lose pretty much all those positive points. So one of the things that you should do is that the oldest the credit card you have, the longer you should keep it. Because those credit cards have more points added to your score than the cards that you got recently, even if they have much higher credit limit. So, especially till the time you're buying a home. So even if it's the very first card that you got when you came to the US, that probably has more points accumulated, even with a $500 limit, than an American Express with $50,000 limit, if you got that card recently. And the way you don't inactivate a credit card is by using it every 3-4 months. Even if it's $25 grocery or $5 gas or whatever you want to, even if you put $1 on that card, it gets reported to the bureaus and an inactive credit card becomes active. So try not to make your old credit cards inactive because they have positive points accumulated and you don't want to lose that. Okay? So we talked about credit, income, employment, asset, pretty much all those terms. We talked about where you can get your down payment from. We talked about the real estate market, where that is and where that is going. Once you have figured all this out, or once you are in the process of doing that, then you are kind of prepared to buy a home. And we get into the next process called pre-approval, which is absolutely the first step that you should do. And at this point of time, I'll get both Amar and Prasanna involved here. So even before we get into pre-approval, there's some confusion, Prasanna, on what are the real tax benefits of actually buying a home. So most people sitting here might know that you can write off your interest that you get, that you pay on a mortgage, and you can write off your property tax. Those are things on primary residence that you can write off. But how much of a real benefit that they actually get, and if you can compare people who currently file a standard deduction and people who don't file a standard deduction. And do they actually get the 33% benefit or 30% benefit, which most of the people talk about, or is this lower or higher? Can you comment on that?
Most of the people here are probably they'll be having state income taxes, which comes under itemized deduction. So most of you might fall under itemized deduction category so far. So in that case, if you're going for a home loan and paying mortgage interest and property tax, let's assume you're paying around 30K of property tax and mortgage in a year, you can expect at least 35%, 30 to 40% depending upon your tax bracket the savings. So you would save approximately around 10K from the 30K you're paying.
And if you can get Amaru on this, so I usually tell people is that pre-approval is the most important thing that you can do when you're. Why do you think Amar pre-approval is an important thing, and why should they do it? Why wouldn't you show homes to people?
Once in the contract, it's only because of that you don't have a loan contingency, and you're trying to figure out the time because you don't have any contingency in the offer process, because you deposit under risk. Sometimes if you don't have a pre-approval, maybe you're thinking that okay, I can qualify based on my income, my credit score, and stuff like that. But in the reality, sometimes you may lender looking into differently actually. So they may look at some how much assets you have, and so bunch of other factors. It's very important. We don't want to take any risk during the offer process. If anything you wanted to, even I know one director makes more than 250K, and I know it's no problem, and I make more. I don't see any problem there and stuff like that. Then we went in the contract, I think that is there for this country for quite some time and good income, everything. But it's when lender trying to pull the credit and he's not paid one of the payment, so that was below 700 actually, 680 or something like that. So it's very difficult for him to qualify loan amount what he is looking for. It's very important that we do all the exercise, understand what is your financials and fully commitment letter from lender in order to make that first step.
So that's an interesting story you told about a director. I'll tell you a story about Google's senior product manager who gave me a call. He said, I'm in contract, I need a loan. I said, okay, tell me more. He said, my base salary is over $200,000. I just moved from New York. I will also get a bonus on top of that. It's a $1.2 million house. I'm putting $600,000 down. So I need $600,000 loan. I said, what's your credit? He said, 780 plus. He said, sounds okay. What happened in New York? He said, I had a condo there which I've rented and moved to Mountain View now. And so I said, is that already rented? He said, I'm in the process of renting it. It should be rented pretty soon. And I told him, you don't qualify for a loan in that case. And he was like, I just don't understand it. I'm putting 50% down. I have 780 plus credit. I make $250,000 plus bonus from Google. And he said, you don't qualify for a loan. I said, you don't qualify for a loan because you have a $7,800 mortgage commitment on your property, which is not accounted for because that's not yet rented. You're just in the process of renting it. It's not rented out yet, which means you have to be accounted for that debt plus the new debt, and then you have a bonus which is future. A future bonus cannot be used towards qualifying income, which means all I really have for you is just over $15,000 of income, and I have a debt for you which is close to $12,000. And of course, he didn't understand half of it, but that's okay. He didn't qualify for a loan. The realtor, this won't work. So this just shows, and there are several examples like this. There are people who move from W-2 to what is called corp to corp, or paying yourself salary, and they think they are salaried because Prasanna will tell you they are salaried. That's what your tax people will tell you, that when you open your own S corp and pay yourself, from tax perspective, you are considered salaried, and that's everything that goes with the salaried person works for you. But when you come to get a loan, we don't consider you a salaried person. If you own more than 25% in any company, we consider you self-employed. And if you're self-employed, you need to have 2 years history of being self-employed for us to use that income. So there are tons of things which people assume that they qualify for because they make so much money, they have so much of credit score, and they think, what could possibly go wrong with me? And I see that story every single time when something does go wrong for them. And that's why it's so important that pre-approval is absolutely the first thing that you should be doing. There are several benefits. I'm going to talk about a couple of those. One, it of course tells you what you qualify for. Sometimes you might qualify for more than what you think, and you're just underballing yourself thinking that you don't qualify for more, or the other way around. Second, if there are any red flags, like the problem with credit, or problem with employment, or income, or down payment, we still have time to fix it. If you try to do that, three, it yourself gives you what kind of payment option you will be getting into. Because a lot of time you can qualify for a higher loan, but you don't want that much higher of a loan amount. Maybe you have other obligations. Maybe your kids go to private school. Maybe you have obligations back home. Or you're just conservative. You don't want to stretch to the maximum limit that the lender will allow you to stretch, and you want to keep your loan amounts under a certain limit. And of course, any realtor worth its salt, like if you want to work with, say, a top realtor like Amar or anybody else, they would most likely not show you houses if you're not pre-approved, because you're wasting their time, and of course you're wasting your own time because you don't know if you're approved to show a loan. And finally, a seller will not accept your offer, will not even look at your offer if you're not pre-approved already. Because what's the point of giving my home to you if I'm not even sure your loan will go through in the first case? So out of all the factors that you see, there's really nothing that should tell you that that's not the absolutely first step you should take when you're thinking of getting pre-approved. So that's one thing that I want to talk about. Now, the loan programs in just a little bit. So I want to bring Amar here saying, so if someone has planned now that this is how they will shape their new home purchase, and they are pre-approved with a lender, and now they come to you saying, okay, we are pre-approved with Shashank and Arcus Lending and we are ready to find a home. How does the home search process go? What kind of consultation do you do? How do you figure out what their needs are? And if you can briefly tell them how the home search process looks like.
Once we know that how much is lender is committed for you, loan amount, and it also gives you based on your down payment, and we know this how much is the purchasing power. Based on purchasing power, we decide what's your requirements, what's your needs, what's your absolute must, and what's the desirable parameters for you. With that purchase price power, we see where do you get that, meeting your requirements. Let's say, $1 million. Okay, within $1 million, where do you get it? Meeting 4-bedroom, 2.5 bath, home kind of things. Where you're working, where you're in your life, and the stage of how many kids, all the situations. So we assess each and every parameter of your needs and the requirements. Then we can see that, okay, now we narrow down the based on your requirements, your purchasing power. We decide the city, maybe even within city we may narrow down to the particular zip code. Okay, let's focus on the particular zip code now, which meets your needs, also within the purchasing power. Then we start looking at seeing some homes for you guys, and we people seeing us. We look into see brainstorm. Okay, what is the couple of things, right? When you look at house, various aspects of it. One is the functional aspect of it. So how is layout, light, all the stuff, the flow of whole house. Second is technical aspect of it, where you physically don't see that one. Any problem with the title, any structural issues, anybody died in the property, or also there is a city red flag that's been on the properties, many other things which you don't see in that one. So those are things, technical aspect, we realtors, closely looking deep dive into those things. That's where you want to take advantage of our realtor expertise. And not just coming to open house. Realtors coming to open house is not going to add any value. So basically you can look at the functional aspect of it, then let the realtors work for you on the technical aspect of it. Make sure that it's not maybe power lines, maybe some power transformers, some other issues. Once both the technical and functional aspect we all been agreed on it, then we look into competitive market analysis. See what could be the possible work for this home. We can work on those parameters. Once we know that, then we can study on the offer dynamics. So is there any offers? Even though this market value could be X amount, there's no offer sitting in the market. We may not offer X amount. So we need to look into offer dynamics. So based on that, we make an offer, and then we can take the negotiation process and try to get the home for the price.
So one of the things, I'll take your question after this, is that what value does a realtor bring to the entire table? That's something that I get asked, especially because when I'm consulting, no realtor is in the room, so it's easier to ask, right? But I came to the country in 2005, 2006. I've bought 5 homes since then, and on every single home that I've bought, I've had a realtor represent me, even though I have been in the industry for this long. It's because I personally believe that the way a realtor can look at a home, at a neighborhood, and what does that home represent in terms of today's value and future value. Even being in the industry myself, that's something that I can do that for me and for my family. So it's very, very important that you work with someone who understands the neighborhood, understands the market trends, and of course understands your needs. Because you will never be able to figure out. It's just there's just so many things that play out when you're thinking of buying a home. It's not easy for anyone to figure that out. You had a question.
So there are another question about the technical aspect of things. Does it also cover the legal aspect of things from the point of view that anything like the title, as you said, or the lease or the property or the grow up?
We look into all the aspect as well. Suppose that we're buying the home, there might be the legal litigation process is going on that one. So we look into deep. We get into look at all the legal documents, from the case. Then we say, man, this is a high risk. It's not worth going to the litigation. It's most likely lenders may not be up to the loan process. It might not. It may be most likely for cash buyers kind of things. We don't want it to be get into the contract. And eventually the loan get not approved. Lender might not know at the time of giving the pre-approval. He's not looked at the property, right? He look at your financials and get the commitment letter. So when the property comes in, even though you qualify as litigation, so lender is not none of the lenders will like the litigation because they're going to put the 80% of their money, own money there. Yeah.
Always have lawyers, the realtor, and the lender. So there are 3 parties to every transaction. So that third party of lawyer is not required.
Yeah, in the Bay Area, we don't. I think realtors, I would say, knowledgeable, to be knowledgeable, and they will navigate situation on that aspect. But required where the dispute or any kind of we think we have that one, we will discuss with a legal consultation within our company. That's why we work for, example, in my case, I work for Keller Williams. That is the nation's largest real estate company. We have a in-house lawyer. So if you have any questions, this is what is happening, what do you think about it, what is the consequences, we take this route versus this route. So they give an advice, we pass on that advice to the buyers and also mitigate that situation.
So while lawyers are not required, any additional fees that you would have used on lawyers, you would like that? So the question is, what's the duration of the pre-approval? If you don't find a house within a certain time period, does the pre-approval still hold good? Answers differ for different lenders. On a typical bank, if you get an approval, that pre-approval is usually good for about 60 days. Every time you go after 60 days, they will pull your credit again and make you go through the entire process again. We don't do that. Our pre-approvals have been good for, in fact, the longest I remember is 14 months. From the time they got pre-approved to the time they bought the home. It's because pulling your credit again and again is not in your best interest, it's not in our best interest. If you're not able to get you the best interest because your credit scores went down, it doesn't make us look good. Meaning your income, employment, assets and credit have remained the same or better, we will just renew the pre-approval letter for you and not just keep pulling credit every 60 or 90 days. Locked. You need to have a property address for the interest rate to be locked, which means your offer should have been accepted on a property for the rate to be locked. So the question is that if you are a contractor or maybe even self-employed and your income is fluctuating, is that something that the lenders don't like? lenders do like to see a consistent income, which is usually a rising income. So either it has to stay same or has to go up. If the trend for the income is fluctuating, if it's month to month, it really doesn't matter. But if it's on a yearly basis, so if I look at 2013, income is lower than what it was in 2013, the lender will go with the lower of the two. And if it has declined so much where the lender is concerned that this income might not even continue in the future, they have the prerogative of saying that they will probably not even use the income at all. Say an income has declined from 100,000 to 50,000, that shows the trend that that income might become zero pretty soon. But if income has declined from 100 to 90,000, with some valid reasons, they might still consider that income. But again, month-to-month fluctuations are not that big of a deal. It's mostly on a yearly basis where they look at.
Getting credit report pre-approval from Wells Fargo versus from you, is there any difference apart from the amount of time it's valid?
So the question is that getting a pre-approval from Wells Fargo versus getting it from me, is there a difference? What kind of difference there could be? Huh? There's no rate locked at the pre-approval stage. Why would you work with Wells Fargo in the first place? Just curious.
Same reason as why would I work with you?
So the way you look at that's something which is very independent answer here, really. Yes. I have nothing against Wells Fargo. They are the largest mortgage lender in the country, so they must be doing something right. We usually flip the equation when deciding how to pick a lender, which is, well, let's shop the rates, let's figure out who has the best rates, and then we'll just work with that lender. And that's usually not usually, some people will probably take that route, which I say is flipping the logic. You work the different way. You look at the credibility and reputation of a lender first. You look at their reviews, you look at what kind of media exposure they have, you look at what kind of standing they have, you look at if they have worked with your friends and family and what kind of feedback they have. You first look at credibility and reputation, and then you look at other factors, which is if they have the loan programs that match my needs, if they will be able to close in time, which is required by the contract, and then if they have the competitive rates. I'll just give you a couple of examples here because I don't have plans to use a lot of competition names here. One of the largest online lenders in the country, which consistently advertises the best interest rates in the country, they have 522 complaints with Better Business Bureau, not to mention one-star review on Yelp everywhere. It's great to see that they have great rates, but how many people actually get that? CFPB recently fined them $22 million because other options, and how, say, someone like Wells Fargo won't do a loan. Say if you are on an H-1B, they don't do FHA loan. Or if you don't have H-1B stamped on your passport, they won't do that because they don't accept 797. So there are several things that they won't do because they only have one product to sell, which is their own bank's product. While for us, if one person won't do that, there's another person who might be able to do something like that. So there are those flexibility that come into place. What I'll do is that we'll take a 5-minute break right now, and when we come back, we'll talk about loan options, which probably is one of the most important things you want to hear. We will talk about the purchase contract, how you write that. Amar will be talking about that. What are the things you should note when you're talking about purchase contract? And then once your offer is accepted, what do you need to do from that time till the time you're a homeowner? And we'll also take your questions. But since we don't have too much time, the tea is at the back, tea and water. Restrooms are to my left, so which is to your right. And Amar needs to announce one thing before.
Back to your Wells Fargo versus this one, is because I deal with all the banks, and it's not about the Wells Fargo or Bank of America and any big banks. It's all about the agent and loan officer. Sometimes the programs in the Wells Fargo and Bank of America, big banks, doesn't have, with the 10% down payment, they have a lot of restrictions. You need to have 6 months of reserves. You need to have a bunch of other ABC requirements in order to get that one. See, in Bank of America, they don't even give the 10% loan, based on more than 625 amount of loan. So whereas third-party brokers, they have multiple options where they work with some other lenders in the back end, make sure they get that one. So they have a lot more flexibility. Reason why? That's one thing. Second thing is, bank is so big, the loan officer is not, knowledgeable and is responsive, doesn't make any difference. Wells Fargo or XYZ officer. Example, I give you that example. One of the Wells Fargo, and Shashank did one with the 10% loan amount. Okay, this is the client is in Mountain View. Client's Mountain View, and we're trying to buy. The Mountain View is very competitive market with a 10% down payment. Such a nice, beautiful house. It's very difficult. Even we had a cash offer. There's 7 offers. One of them was cash offer. Our offer was 10% down payment. That time, when I was talking to the loan officer, the listing agent, were presenting an offer, listing agent, I called Shashank. He was in Jamaica actually, and he picked up the phone. He was in wedding in Jamaica. That was, and he picked the call, and he was conference call with the listing agent and me, and while presenting an offer. She's very concerned. Why should you go with, there's a 20% down payment, there's a cash offer. Why would you go with a 10%? I said, at the end of the day, I understand that you don't get, it doesn't matter what is the down payment is going to be, and other day we're going to close it. Here is a loan officer is guaranteed to close it. There's no absolutely, there's no issues and stuff like that. He was standing and step up and put his word and all these things, to the listing agent. So we were able to close that one, correct? So he was there in Jamaica, it's the wedding. You should be able to access that loan officer at any point of time. I'm busy, it doesn't matter, Wells Fargo. It's a very important matter. But apart from that, this third-party companies has more flexibility, to get to that one.
Okay, thanks, Amar, for that endorsement. As I said, we'll take 5 minutes break and we'll come back at 2:45. So the question is, if my score is higher and my spouse's score is lower and I can qualify on my own, should I put spouse on the loan or not? You should, from a lending perspective, you should not, because you'll get a better interest rate if you were to just go on your own. But if you have to put your spouse because you don't qualify on your own, then you have to. Then of course you're left with no option. One question which multiple people ask, which is, can we use money from friends as a gift? And no, you cannot. As in, friends can't gift you money. The definition of gift is that a money which is given to you and you're not obligated to return it back, which of course doesn't happen with friends. The only way to use friends' money for down payment or reserves is to get that money into your account 60 to 90 days before you are to take a loan. And because most lenders will only ask for last 60 days of bank statement, they will not see the deposit and they won't ask it, and you don't have to lie. So it's pretty straightforward. You can work with that. I'm thinking, was there any other question which should have helped other people? Let's talk about loan options. So we talked about the fact that one challenge that most first-time buyers face is the down payment because of the price points that we have here. With that being the case, 20% down payment is not something which is available to everybody. In fact, probably 70 to 80% of my clients do not have 20% down payment when they're buying their home for the first time, or maybe even higher. So that being the case, we need to look at loan options which allow lower down payments, which allow down payments, say 5% or 10%, definitely under 20%. Now, I don't want to get into the details and the guidelines of every single loan program we offer, but I want to broadly talk about some of the low down payment option loans. Now, the lowest down payment option loans are usually for loan amounts which are $417,000 and lower, which is you'll probably be buying homes in that range. There are very few homes available in that range to begin with. But if you have a loan amount which is $417,000 or lower, you can buy for as little as 3% down payment. If you have loan amounts exceeding 417, then 10% down payment is your minimum option. And you can do, we are right now doing a loan on which the purchase price is $1.38 million, and we are doing a 10% down payment. Even for us, that's a record. We have never done a purchase price as high as this with 10% down payment. But we can go all the way up to 1.4 million purchase price and can do a 10% down payment, which is mostly the price range for first-time buyers, and there will be very few who will actually exceed that price range. Now, there are several ways to structure it, and as I said, I'm not going to get into details of what will be your first loan amount, how much will be your second loan amount, what will be the rate on first or second, unless you have specific questions, I'll get to that. But what you need to know at this point of time is that there are options And all these options that I'm talking about are with no mortgage insurance, because that's another concern which a lot of people have, which is, oh, I have low down payment option, or I have less down payment, so I'll end up paying mortgage insurance. And mortgage insurance are typically very expensive. They're, depending on your price range, they can be anywhere from $200 to $700, $800 a month. And the bigger challenge is the mortgage insurance is not tax deductible. So you're not just paying mortgage insurance, which has no value, so to say, you're also not getting any tax benefits of doing that. You would rather pay slightly higher interest rate, because as Prasanna mentioned, the interest from that is tax deductible, than pay mortgage insurance, which has no value. So we do these 10% down payment loans depending on your loan amount and your credit in several different ways. Sometimes we do just one loan 90% with no mortgage insurance, so there's no second loan on it. Sometimes if you exceed a certain loan amount, usually once you get into the $700,000, $800,000, $900,000 kind of price range, then we have to break the loan into two. We do what is called an 80-10-10 loan. We do a first loan, which is an 80% of your purchase price, and then we do a second loan, which is 10%, and you bring in the rest 10% to the table as down payment. And most of these loan options, we have no reserves requirement, which is crazy, but which is amazing. Because you can buy an $800,000-$900,000 home, only show me that you have $90,000 in loan, and I can give you a loan. I don't care if you have a dime left after you have closed on your transaction. As long as you have enough money to show that you can bring in the down payment and you can bring in the closing cost, we don't have reserves requirement on most of these transactions. I'm not saying everything, but most of these. If you go all the way to 1.4, the example that I'm giving you, then we do have some reserves requirement at that kind of price range. But again, even on reserves, we are able to use things like 401k or vested stocks or your shares that you have bought just in your brokerage account. So even if you don't have liquid money sitting in your checking or savings account, even those can be used as reserves. And so that's another good news that you're able to do that. One specific question was about FHA loans, because FHA loans is something we wanted to talk about. FHA loans. FHA stands for Federal Housing Administration, which is a government body. So these loans are insured by the federal government. By insured, it means that if you were to ever default on the loan, the government pays the lender for whatever loss they had to incur because of you defaulting. In exchange for that, the government asks you to pay their mortgage insurance premium, because that's the money that they collect, they keep it in the pool, and if anyone ever defaults, they take money from that pool and pay the lenders. So FHA can be expensive because you have to pay mortgage insurance premium to FHA, but also their interest rates are much lower than other loan programs. So it kind of gets offsets because even though you pay mortgage insurance, but you pay lower interest rates, so the net difference is not that higher than, say, other loan programs. One great benefit of FHA loan, of course, is that they allow as little as 3.5% down payment all the way up to $625,000 loan. So you can buy a 650, 660 kind of a property, put only 3.5% down, and you can still own that home. Now, there are several other benefits of FHA loan. Sometimes a person with a very low credit score will almost get the same interest rate as a person with a very high credit score, because FHA is more lenient with lower credit scores. FHA is more lenient with gifts coming from family members. They even allow cousins, which a lot of conventional loan might not allow, because they only allow, say, parents, siblings, in-laws, and they may not allow cousins. They are okay with, as I said, very low credit scores. So FHA loan programs actually are much more flexible for first-time home buyers. The only challenge is that you pay mortgage insurance, which tends to be expensive, and their mortgage insurance does not go away for 30 years. So once you start paying them, you will keep paying them till the time you keep that loan. If you ever were able to refinance, then of course they have no prepayment penalty. You can refinance them to another loan, and then you are safe. But for some reason, if you're not able to refinance and keep that loan, then the mortgage insurance never goes away. Irrespective of how much equity you have, how much loan you have paid down, you will still have to keep paying mortgage insurance for the life of the loan. So that's something which, of course, I don't like about FHA. And also sometimes the listing agent may not like the FHA option too much. Amar, why is that?
But actually, from a seller perspective, end of the day, you get the purchase price, right? The only difference between the other loans and any other cash or an FHA or conventional thing, but in the FHA, the down payments of that. Why the seller little bit of hesitant to go with the lower kind of this FHA and some other this thing. Some reasons some appraisal coming low.
Your biggest challenge usually is not credit, the down payment. And that's where I want to get Prasanna's opinion on a couple of things here, which is, so of course, one way of getting down payment is just from your own savings. If you have money in your checking savings account, of course you can use that. You may have companies' stocks, you may have your own stocks, of course you can sell that and use that towards down payment. But if you're trying to use sources which are not that conventional or do not come to your mind right off the bat, and that's something that we talk about consulting to home buyers, which is things like getting loan from 401k, things like getting gifts from your parents or getting gifts from your relatives. And one of the questions that I get asked all the time, which is, what are the tax consequences of doing this? So if I get gift from my parents in India, or if I get gifts from my siblings here in the US, or if I borrow against 401k, how much tax do I have to pay for something like this? So Prasanna, if I can get your opinion on two different things. Question one is the 401k as a loan versus if you are just withdrawing from 401k. What are the different tax implications of this? And then I'll come to the gift part after that.
Thank you, Shashank. This is Prasanna, IRS agent. Basically, you can go for withdrawing, borrowing loan, okay. Yeah. You have an option to borrow up to 50% of the account value or maximum of 50,000 or if you're going for a home loan procedure kind of thing. So there is no interest, it's going to be your own interest you're paying to your account. And if you're planning to withdraw money from the 401k, you will be subject to our taxes. Your taxes are going to be based on your tax rate and there is a particular penalty. However, if you have IRA, traditional or other kind of borrow, you can withdraw up to 10,000 from your IRA account. If you are using that 10,000 for home improvements or to acquire a home, there won't be any early withdrawal penalty. So basically, there are two things involved. One is the penalty and the other one is taxes. So penalty is applicable if you withdraw money from 401k or the IRA account. So in your case, if you withdraw up to 10,000 for buying an house, there won't be any early withdrawal penalty.
Has a 401k account, they can borrow up to without any tax implications. And the interest that they pay on a 401k loan is paid to themselves. So really they're not really paying to a bank or somebody else. Okay, that makes, of course, getting a loan against 401k one of the best options to use for down payment. Because one, you're not paying, it has no tax implications at all. And two, the interest that you're paying is actually the interest that you're paying yourself to your own funds. That's great. But withdrawing from 401k, of course, is not a great idea and it should be avoided if we can. Okay, let's talk about the second down payment that we talked about, which is gifts, which again is a very common form. I'll come to you. Which is a very common form of gift. Talk about getting gifts from here, someone, say my siblings live here, or even my parents live here in the US, versus getting the gift from India, and what are the tax implications for people living there, or what are the tax implications for me as a receiver of the gift?
Okay, gift from US person, so the donee has no tax implications. You don't need to file any form if you are getting a gift from a US person, but the donor has the tax implications. If donor is giving more than 14,000 per a person, they will need to file a tax return, gift tax return. However, there is no taxes payable on it because there is a exemption credit on the gift tax filing. And if a person is married and there are no tax implications. If you are going to get a gift from a foreign person, you can get up to 100,000. 100,000. There is a form required to reporting required to IRS. However, there is no tax on it.
That's another good news. So again, 100,000 from out of country person, and even within the country, even though they have to file a form, they really don't have to pay any taxes. So 14,000 or 28,000 if they're married. 20. You guys had a question back there. What's your question?
I know often from the IRS,
Prasanna, did you hear that?
Basically, 401k will not allow you to withdraw money. So if you are withdrawing from 401k, there is no early withdrawal penalty exemption. Only IRA, traditional and Roth will have an option to withdraw up to 10,000.
No, but can they get a loan of 50,000 from
You can get a
401k
loan
plus?
of 50,000 from the 401k.
So you can do that. Can you let us wait for them?
We talked about free trade from in a foreign.
Right. Yearly. Yearly. So let's assume you have two people who can give you from a foreign country. If you are getting from one person 60k and the other person 60k, totally 120k per annum. If you are getting more than 100k, then you need to file more than 100k. That's right. No, it remains like 100,000. Even if it is divided, since we are filing, if tax return is filed as a joint, so if you get more than 100,000, even if you split that, then you need to report that transaction. There is no tax implication, it's just a reporting exercise. There is no reporting.
Okay, perfect. So those are some of the ways you can try to get your down payment if you don't have your checking savings account. And try to keep your questions towards the end because you will have enough time to ask that unless it's very pressing and you need to absolutely ask it right now. I would rather follow the pattern and try to get everyone all the information they need and then get you out by the time we committed you to be out of it. So we talked about assets, we talked about the real estate market. Now let's briefly talk about what are the requirements for credit, income, and employment. Because a lot of us come to the country and we are not fully prepared in terms of what kind of credit history we have, what kind of income or employment history we have, and then we run into challenges when we try to get a loan. Rule of thumb says that you have to have 2 years of credit, income, and employment history in the US to qualify for a loan. There are exceptions. Talk to me separately and we'll talk about some of the exceptions that are available. But broadly speaking, you need to have 2 years history for everything. You need to have 2 years of credit history. By credit history, it means when was the first time you took a debt when you came to the US. So when was the first credit card you got, when was the first you reported to your credit report, and then you have to wait 2 years after that, and then that's called 2 years credit history. Same with income. You need to have 2 years of income history. So in terms of contingencies, we talked about the loan contingency and the appraisal contingency and the inspection contingency. And of course, one of the terms of the contract is by when you need to close the entire loan. And so typically, as in that could be anything from say 20 to 45 days, depending on which market you are and where you are buying. Of course, these days it's very rare to see anything exceeding 30 days on the contract. Now, once you make an offer, Amari, if you can also walk through what happens when you make an offer. What is, say, a counter offer, or how do they accept an offer? Just quickly talk about how the offer process works.
When you make an offer, there could be 3 choices seller make. One could be accept your offer. Second option could be give the counter offer. Man, I like everything. The price is a little bit less than what my expectation. You may say, let's say 600. You made an offer. You may ask for, okay, can you give me 610? The counter offer process, that is. Then buyer say, come back. Oh, I don't give 600. Okay, how about 605? So that's the whole process goes through back and forth between the buyer and seller. And the second option, third option could be they don't even respond. They basically reject your offer. So the 3 options could happen once you make an offer. 3 choices.
The challenge with the home offer process here is that it's like playing a blind game. It also depends on what kind of connection your own agent has with the listing agent. Sometimes listing agent will be willing to provide a little bit more information to your agent if they have a good relationship going. I'm not sure if they will still give them the exact price at which the other buyer came in, but they can give them an indication saying that your offer looks lower than what I already have. So within the guidelines, they might give some indication to your agent saying where they are and if you want to increase the price. And so it is still a blind process at the end of the day, and you have to go with what your realtor's assessment is and how much your own comfortable range is, and that's how you make an offer on that.
What's your take on making the seller agent as your buyer?
I don't know. I mean, basically you're asking, representing, the one side or both sides of the party, right? This is one person, one side will be compromised. I don't know. That will be right. I don't represent the both sides because one guy with a buyer or seller got hit, 100%. Trust me. This is very practical, right? So the seller always wants higher a number, and the buyer always wants lower. So he's trying to represent both. It's it's very difficult. I mean, people say this is okay, can be done. People go, and I know that because I happen a lot of realtors conferences, realtors meetings, and the person is end up paying, happen to run with the listing agent paying much higher than any other offer on the table. Why? Seller will, let's say the listing agent brings the both offers, okay, buyer side on a buyer side offer. Seller knows that when tomorrow one problem comes in, the agent is going to represent seller or buyer. Right? He's always back of his mind tomorrow. So buyer can come back in next 4 years, any problem, stuff like that, he can sue the seller. So where the listing agent where to stand on it. So that's why that's an offer is 600 and all other offers are 605, 601. Unless the 650, something like that, the listing agent brings it to the table, seller will not take that kind of risk taking the listing agent offer. I guarantee on that one. Okay, you may think you got the house, you paid much more than that. The 600, and so there are other offers are 600. Why would seller take it? Because seller has a risk tomorrow problem. He's representing both sides. Seller has a risk, tomorrow in the event a problem comes in.
Yeah, if I had my way, I would say that dual agency should be illegal. It's just there is absolutely no way of representing two people with very different goals fairly. I know of lenders who do not accept loans where the same agent is representing both the buyer and seller because they don't know if it's a fair terms on the contract.
How are your multiple offers I asked how are the multiple offer situations generally handled from the
Listing side, from the buyer side.
from the seller's perspective?
So how do they look at multiple offers?
Yeah, I mean to say, is it required that the seller once he or she gets the offer, stop accepting any other offer?
So once they have accepted an offer, will they stop accepting other offers?
Let's say I'm a buyer and I made an offer. Normally in multiple offer situations, it would happen that the seller puts up a date and says that I'm taking the offers on this particular day from all the potential buyers, right? And then they will consider all the offers.
Mm-hmm.
But once I put in an offer, let's say before that date, is the seller really required to consider that and that offer only?
Okay.
Today there's an open house in 9512 zip code. Actually, last night we seller accept an offer, but their open house is going on today and tomorrow. But it's always done, offer is done. Just to give you an example. So all depends upon listing agent and also the buyer agent relationship, how well they're done, kind of thing. So that is how it's. My buyer liked the house, they really want the house, and we want that make it happen before the open house, before getting the multiple offer situations. Because that's going to be next Tuesday or an offer deadline. You don't want to get into that part, this situation like that. Yeah. Right, if you're able to convince the listing agent, and so that the offer is so good, and also it's guaranteed to close, it depends upon the buyer agent how good it is, that one. Okay, it's not about an offer. Many times, if you can do your own research, Google my name and look to LinkedIn, you see hundreds of the home buyers' experience written there. Even the cash offer was 600, my buyer offer was 590, they accepted that one. Okay, Chinese listing agent, Chinese seller, and we said we close that one. It all depends on that's written there. Our buyer is a Siley, software engineers LinkedIn. You can see that in the LinkedIn recommendations. So it all depends upon, it's not even though you have multiple offers, this all depends upon what is the quality of the offer, the quality of the agent. This all matters. Somebody give you, this thing with so many contingencies, stuff like that doesn't make any sense. So somebody give less the amount, little less the amount, and also the process in that one, the listing agent is more comfortable working with that agent. So the offer timings are very important. Not I go to that agent, get some money and do. So if you want to do the good job, or you do just a paperwork, or else you want somebody to really guide you, along the process, it get you much more benefit to negotiating, to the listing agent. Yeah.
Let's jump on to the next topics, and we'll come back to the questions. So we talked about the fact that you make an offer. We can get into either the seller accepts your offer, declines your offer, or makes a counter. Again, the same thing can happen. They might accept it, they might decline the offer. Assuming the best here, which is that your offer does get accepted, because if it does not, then of course you go back to the drawing board and start the home search process again. If the offer does get accepted, then what you're looking at is that you're looking at the contract terms. You're looking at what did you offer on the contract, and then you have to do all that you can to make sure you meet the terms of the contract. So if you offered, for example, that you will have the loan contingency taken care of in 10 days, what that means is that your loan needs to be approved in 10 days. If you say your appraisal contingency is 15 days, then what that means is that your appraisal will be done on the home within 15 days, and you have decided if the appraisal is good enough for you to move forward. If your contract says that you will close your escrow, meaning the entire process, in 30 days, then from the time you sign, the seller signed the contract, because that's when it becomes effective, to the time you are recorded in the county as the new owners of the home should be 30 days. And these are all calendar days, by the way. These are not business days. So once your offer gets accepted, really all you're looking at is that, what did I offer on the contract? And that's why it's very important that your realtor and your lender works in tandem, because sometimes realtor may either be very aggressive or very conservative, meaning that they might go in for the terms which your lender is not able to meet. They're going in for too aggressive timelines which the lenders can't meet. Or they think that the best the lender can do is 35-day close, while, say, we can close in 21 days, for example. So they're not being aggressive enough when they can, if they check with the lender. So when we pre-approve our clients, we always ask them to connect their real estate agent to us, so that we are always in a relationship trying to understand that when they're making an offer, so that we can advise them of our terms, and also make that call to the listing agent when the offer is made, which is the example Amar was giving. Because listing agents feel extremely comfortable if the lender takes that, makes the effort to make that call, even before they have called the lender, because they think if this guy is calling me now, then he'll be responsive throughout the process. Also understanding, because usually, as I said, most of my clients are anyway not the best clients, in the sense that they don't have 20% down payment or cash offers. So the offer that you're accepting is as good as cash, because we'll still close on time and we'll still make sure that the seller gets the money. Okay, give me 1 second. Let me finish this. So your offer gets accepted. You need to meet the terms of the contract. What is most important from your side, always, which I sometimes find extremely baffling, is that you don't do your best to get everything that the lender needs. I'm surprised how many times we have to follow up with the borrower, like, oh, I sent you this, you haven't responded. I sent you this, you haven't responded. Understand that you are under serious timelines here. I advise my clients that get back to me things we ask for within minutes. If you're in a meeting, I understand, then you can take a few hours. But that's at the most I allow you to take. Because there are so many things in the process that we don't control. As lenders, that's just one side of the business. There are realtors on one side, listing agent and buyer agent. There's escrow company, there's appraisal company, there's inspection company, there's home insurance company. There are so many things, there are so many people in the process that we manage. And there are only so many people that we control. We can't force an escrow officer to send us something within 5 minutes. It's their call, really, at the end of the day. So that's what I advise my clients, is that let's focus on the things that we control, which is how fast we move and how fast you move, because those are things we control. So try to get me everything that you can within minutes of everything that I ask. And then everything else that we don't control, we can only follow up. That's what we do. So it surprises me that how many times we have to follow up to people to get even basic stuff. Like, hey, have you finalized your home insurance policy? No, I'm still shopping with Geico, State Farm. Doesn't really matter. Pick one. You can always change your insurance company tomorrow. It's not that big a deal. And it's a $5 or $10 difference a month. It doesn't make too much of a difference. But don't take 3 days to finalize your home insurance policy. What Amar does is that when he has a client get into contract, in the same email he copies the home insurance agent that he recommends. That way you can shop for it on day one and get your home insurance finalized. You're not paying for the premium yet till the time you own the home. But at least that process is taken care of. So the more things you can do at your end which moves things faster, because there are a lot of things that you don't control and we don't control, and things can go wrong at times. So when you have a contract in place, that's what you do, is that you find the loan options again, go through the loan options that you discussed during pre-approval, find out the one that works best for your new needs if anything had changed, lock the interest rate, we get you to that you supplied during pre-approval may not be updated anymore. And we get you through the loan process. We get your loan approved, we get your appraisal done, we work with all these parties for you, really, because you don't have to talk to anyone. We take care of everything, all the coordination. And then if everything goes well, then you're closed within the time period by which you need to close. Your loan gets funded, you go to a title company, sign your legal documents, and you are recorded in the county as the new home buyers, and you get your home keys for the contract. And that's how the process works, that I know. No, so the question is that you talked about contingency period and you talked about escrow period, which is usually about 30 days. Does one start after the other? It's simultaneous. So escrow period starts the day the seller accepts your offer. From that, whatever you committed. So you said 30 days, you will close your escrow, meaning you will be recorded. So 15 days of contingency or 10 days of contingency is part of that 30 days. And that's why I'm telling you, there's so many things that needs to be done in that 20 to 30 days that if I were to actually put it on paper, there would be like 70 different items that we'll have to put on that paper. And imagine, and for us, we have to do that in business days, not calendar days. So if you come in with a 30 days contract, I actually have to fulfill that in 21 days. Because that's all that I get in terms of closing it. There are several things that defines what goes in that. How many people you are competing against. That's one thing that defines it. If you're competing against nobody, leave and put 60 days in there, really. The seller still has to take it. What option do they have? So one is the market dynamics. How much of demand and supply are we talking here? If there's more demand than supply, then you have to be aggressive than what you could be. Two, how much is your lender willing you to stretch to? As you can't get on a 10-day close if that's something which is humanly not possible, even if you wanted to. Third, how much is your own comfort level? Meaning, if the realtor tells you that the only way to get this property is by going with no appraisal contingency, because all the other offers are with no appraisal contingency, but you know that that's required for down payment and closing cost, then it's a potential problem for you if the property appraises for lower. Because if it's lower and you have no appraisal contingency, you can potentially lose the deposit that you made because now you have no additional money to bring to the table. So there are several factors. It's your own personal factor, it's the market dynamics, it's the players that you work with, and you work with their advice. That's what you do. Okay. So the question is, what is closing? By the way, the floor is open for questions now because we talked all the way to the closing process. How much is the closing cost? So there is a term called cash to close, meaning how much cash you have to bring to the table to close this transaction. And cash to close is made up of two items: your down payment and your closing cost. Down payment is also broken down into two different things. You have to bring in a deposit of 3% when your offer gets accepted, which is part of your down payment. So if you are in a loan which has a 10% down payment, you pay 3% up front, you will bring 7% at closing. Plus you will have to bring closing costs. What closing cost is typically is lender fees, escrow fees, title fees, government fees, and there are some prepaid costs that you pay at closing. Typically I advise that 1% of the sales price is what you should budget for. However, if you are very low on price, that number may be higher than 1% because a lot of costs are fixed costs, which are not a percentage of the sales price. But if you're too high on the loan, on the purchase price, meaning if you're buying something for $1 million, $2 million, $5 million, then that percent, then you may not have to go all the way to 1%. Then even a 0.6, 0.7% may be enough for you to cover the closing costs. Of course, it's a ballpark number you're looking at. So someone who has 10% down payment loan, I tell them that you need to be ready with 11%. And then more or less, plus or minus, you should be okay. Which is, so next question was, what's the difference between buying a home from a seller versus buying a home from a builder? Was his first part is will you be talking about the second loan as line of credit? So we talked about the fact that the 80-10-10 loans usually are, there's a first loan of 80% and the second loan of 10%. That 10% loan is usually line of credit. And what line of credit is that it's like a credit card. They give you the limit, you can use as much of it as you want, and you're only charged interest on the part that you use. So if you can use that in the later part of time. For example, if you have a $100,000 line of credit that you got because you're buying $1 million home, your first loan is $800,000, your second loan is $100,000, and that $100,000 line of credit, if you pay that down to say $80,000, you have that extra $20,000 available to you that you can use anytime, just like a credit card. The more that you pay down, the more you have available to use it at a later point in time. Also, your payment will only be calculated at $80,000, which is now there. So on a line of credit, your payment actually goes down every month. As you keep paying your principal, your payment keeps going down. However, on the first loan, even if you pay more on the loan, the payment remains same, you just pay off the loan faster. But they don't change the payment every month. On a line of credit, they will actually change the payment every month, and they will allow you to draw from whatever you have paid at a later point of time. So if you want to do that. Interest rates are of course different. The second loan is much higher than the first loan. That 10% down payment rule remains the same. You can bring in gifts, you can bring 401k loan, you can bring in IRA, you can bring your Roth IRA, you can do all that stuff. There's none. How much can you handle that part of it? If you're buying a home from builder or seller, how is that different?
In the builders, usually you have the loan contingency. If any builder, they give you 30 days. I actually, 3 days of registration period that once you sign the contract, within 3 days you are right to cancel that one. After 3 days, you have 30 days, to basically the loan contingency. The appraisal contingency, generally, builders, they won't allow that, and usually that's not the case. It will not be any problem on the builder side because they would have sold the previous homes, higher price. I don't see any problem because one is going to be the available higher than what the previously sold. There will not be any appraisal issue.
What's the trend for appraisal contingency? All of the
Usually this is in the Bay Area, mostly they don't put appraisal contingency because people have some reserves in case the event comes in. We didn't, so far I'm not running into appraisal contingency issues so far, kind of things, and we are very calculated. Yeah.
Yes. So the question is that on FHA loans you have to pay mortgage insurance. Is there anything else any other insurance that you pay? Mortgage insurance is taken for the protection of the lender. That if you were to ever default, they get reimbursed for their loss on this. Home insurance is taken to protect your home against fire or flooding or anything else. So those are two very different kinds of insurance. Next question.
Some realtors market that they would give the commission back that could be used as closing costs. What are your thoughts on it, and how would Amar work on that?
So your thoughts on can that be used?
No. How would this Amar work on that? And some people are saying that if you don't need to give back, or some people give back. So how does that work? The commission.
So what I'm still trying to say. Okay. What is the question?
So the question is, how does Amar work with that? Does Amar give it back?
Oh, okay.
Or is it good to go to a person who gives it back or not?
Yeah, basically we get dollars at the end of the closing.
So that's your question.
Yeah.
Man, you are right to go to who are giving the money to you. Okay, that's my advice. Okay, that's why you make a call on that. Yeah. Huh? I don't need a customer who would think a very narrow mind. I'm not just a give an idea. Okay. the guy is giving you, legally by the way, if anything you give you out of this contract, it's a lender fraud. You will not disclose to lender and seller. If there's somebody giving the money to you, you will not disclose lender fraud, okay? That's a felony, okay? Other thing is that, from the IRS perspective, anything you receive more than $500, you need to report. You receive 1099. That is, in IRS also you are making fraud. That's also criminal charges, by the way. Okay, federal charges. Will that be okay? Why other agents are doing it? That you need to ask them. Okay, I want to protect my buyers and sellers and everything like that. So suppose in case somebody giving the money, that has to be, lender has to be approved. Lender has to be informed. Lender has to sign off that one. Seller has to be approved. Seller has to sign off. If you go to any builders, you sign the 2 pages of paper in escrow saying that I have not received the money from the buyer agent. There's a legal terms there. Okay, you sign that one. You still receive from the buyer agent. You know what? You ask a lawyer. Take that paper from the builder. You sign that one escrow. Go to lawyer and tell me, ma'am, I signed this document. I still receive the money from my buyer agent. He will tell you what's the consequences.
Yeah, question. What is first-time homebuyer credit? There is none. There is no benefit of being a first-time homebuyer. I get that question a lot. Is that if I'm a first-time homebuyer, do I get anything special? You get nothing. There used to be a first-time homebuyer credit back in 2009 when the real estate crisis was very deep, and the government was giving up to 10,000, and then California state was giving, if I remember, another 7,000 on top of it to first-time buyers to just spruce up the real estate market. That stayed for a few months. But really, as of date, there is no special. Even the FHA loans that we keep talking about is for anyone who is buying a home for primary residence, not just first-time home buyer. You need to live in the home to get an FHA loan.
Just for the sake of clarification, the appraisal of the property that you're talking about is the home inspection.
The appraisal of the property is the same as home inspection. It's not. Home inspection, home inspector is a different person altogether who figures out the condition of the property. Do you have problem with plumbing, electricity, the floor, foundation, roof, etc., etc.? While the appraiser's job is to find the value of the property. And so they don't go into the details of looking at everything. If there's something visual, like your roof is broken or something, they'll report it. But they don't go into detailed inspection of the property. Your question.
If you have how much of it goes into the escrow? If anything goes wrong,
3%. That's typically the term of the contract. Is the initial 3% deposit goes into the escrow to begin with, and then the balance of the down payment comes.
in terms of the property appraisal, doesn't the city provide that? Again, I'm trying to compare.
Okay, and I'll move quickly on questions now because we're running out of time here. He's saying that in terms of property value, doesn't the city or the county give you that value? Those are two very different things. The county tax assessor's value may or may not match with the appraiser's value. Also, when you buy a home, your property tax is automatically calculated based on the purchase price. It really doesn't matter how much the property appraised for. We'll take